Hello, I'm Dominic Hobson, co-founder of Future of Finance. My guest today is Goncalo Lima, Capital Markets Ecosystem Lead at R3, the provider of private, scalable DLT platforms to regulated financial industries. Our topic is the future of post-trade infrastructures in the securities, money, and funds markets. Goncalo, thanks for joining us.
Thanks for having me, Dominic.
Now, post-trade seems a deeply natural candidate for DLT. It's got very high and costly levels of intermediation and reconciliation activity going on in the background. Yet progress has been agonizingly slow. Why do you think that is?
Thanks, Dominic. My view is slightly different. I think DLT is definitely the right technology for the post-trade space. I think we all probably suffer from the fact that we are living it, and we are all impatient, and we see all these benefits, and it takes time to actually implement these projects. And my view is that better safe than rushed, particularly on the regulated space. So we need to ensure that when we do these big deployments, such as STX and others, it's safe and it ensures that the main function of these FMIs that are currently ensuring the safety, fair and efficient markets for all of us, they continue to do so in a more efficient way with DLT. So I agree with you that DLT is the right technology to ensure that inefficiencies in post-trade and risks are removed, and some of the silos are removed as well. I think in terms of the speed, yes, for us that live in it, we feel that probably it should be adopted faster, but we want it to be done safer, and the adoption will come after.
I wondered if the ownership structure of a lot of financial market infrastructures plays a role here. You often hear people working for CSDs and CCPs, indeed even occasionally stock exchanges even these days, despite everything that's happened, that a collaborative approach, a sort of mutually owned model is the appropriate one for financial market infrastructures. Now, do you think that is a model which would actually help the adoption of DLT, or should we have a more competitive approach in which, I don't know, some CSDs adopt DLT and go down that path and others stay where they are and we see what happens?
I think, thanks, Dominic. I think what we are seeing currently is that a lot of the central exchanges and CCPs and even central banks, they're all either trialing or doing live projects on these. My view is that there are definitely places in post-trade or parts of the post-trade flow that are less competitive, and they should be collaboratively addressed. So the main reason for me to say that is if things go wrong on the post-trade space, they can be quite costly to the participants. So a collaborative approach is the right one. There are other processes that might be competitive. So for example, some participants might do compression, or might do novations or some other activities using the trades that have been done elsewhere. And for those, I think competition will still exist. But I think the whole idea of DLT is that you will have the network that processes that are less competitive can be done safely and collaboratively, and processes that will remain competitive, different participants will come, and the end client will choose who to opt in. But my view is that the post-trades currently, from settlement to custody and so on, there are areas that are non-revenue accretive, and if they go wrong, they can be quite costly. So it's on those processes that I think the optimum point is to bring together the different participants to ensure that the main function of FMIs remains sound, which is fair and efficient markets.
Right. Now, you've emphasized in both your answers that these infrastructures, failure is not an option. They have to be safe. They have to work Now, I wonder what part regulation plays. Nothing unusual in regulation. It's regulated markets, as I said at the outset, of what R3 specializes in servicing. So is regulation a negative factor here, by which I mean that there is no single set of digital asset laws in any of the major markets or across the major markets, which gives people the confidence to go down this path? These are regulated entities, their users are regulated entities, but you've got this balkanized system, different digital asset laws and regulations across the North America, Europe, Asia. Is that a factor which is weighing on the minds of some of the entities you talk to, which is weighing against them committing fully in terms of investment to creating this DLT-based post-trade infrastructure?
So regulation, for sure, as you mentioned at the start, we are active in that space. I think regulation previously was was perceived as more of a blocker than it is now. Currently, I think the perception is changing, and much to the credit of the regulators themselves, that actually are bringing pilot regimes, bringing sandboxes, and encouraging the industry to adopt better practices. I think the Bank of England report on the post-trade emphasizes that, yes, whilst the post-trade is functional, it's still complex and can be made more efficient with other technologies. So going back to your question, regulation, yes, the lack of harmonization across states doesn't help, but I think regulators, via consultations, via different regimes, they're trying to encourage people to participate actively, and harmonization standards will come over time. And what I think it's quite interesting is that the collaboration amongst private and public sectors on the adoption and on how to engage with this technology has been quite constructive. And we saw the BCBS consultations and others that are very, very much proactive in getting the answers from the practitioners and trying to build that into the regulatory regimes.
Mm-hmm. Now, we do have experience of a regulated DLT-based CSD in the shape of ID2S, which failed recently. It was aimed at the French and hopefully wider European commercial paper markets. Now, one of the reasons among the reasons for the failure of ID2S was an unhelpful regulatory regime in the EU. You had to record and settle assets inside a traditional CSD. And then the European Union also had this proposed regulatory sandbox, the so-called pilot regime, which you've just referred to. One of these sandboxes can be helpful, but this one appears to be unhelpful in the sense the thresholds, or the ceilings, is probably a better term, for issuance and market cap are set relatively low. I mean, I don't know, you probably have a view on why ID2S failed. Maybe you'd like to share that with us.
I think a lot of what I learned, and I think your interview with Andrea Tranquillini was quite helpful to me. And I think one of the lessons that we all have from experience and from life is that timing in business is usually critical. And I think ID2S was one of those examples. Whilst the idea and the construct is still valid, it was, in my perspective, and again, from what I read, I wasn't particularly involved, but from my perspective, it was the timing. I think technology was being made available, and it proved that, yes, it can work. But the regulatory regime was probably one of the biggest issues. And the problem I see, more than the regulatory regime in which ID2S was the business. So the problem is that most of the businesses these days, they have a time frame that very quickly requires some return. And I think the regulatory regime timelines might not have been coincidental with the business needs of the people funding ID2S, because I think the idea is sound, and the implementation was what has failed. But I think all failed and successful projects are always big learnings for the industry, and I think we all learned that regulation can now be an enabler, Timing the investments to the uptake of demand is critical, and I think we all build that into our projects going forward.
Actually, one of the points that Andrea Tranquillini made in that interview, he's the former CEO of ID2S, was that actually the wider ecosystem wasn't that supportive either. And that strikes me as a case where the regulators could have intervened to say, well, actually, you need to interoperate with this entity if we're going to get more competitive and productive financial markets. Do you think that's a positive way?
Yeah. I read that point as well, and I think that has now the context is now completely different. I think regulators are engaging not only on the DLT for post-trade. Bank of England came out with their report on post-trade, but also there's also a lot of engagement on the central bank digital currencies as well. So I think his context was probably different from the context that we are now experiencing, and I'm sure his experience and his learnings will be adopted more widely. But I think the context now is completely different, and the proactiveness is there.
Now, another area in which regulators are proactive, if you like, is in shortening settlement timetables, certainly in the United States. Is there a way in which DLT can actually help the industry progress towards settlement on T+1? You've got a lot less time. Whether we go to T+0 or not, I don't know. But can DLT help with shorter settlement timetables?
Yes, so that's the short answer, and we could end the response there, but actually I'll try to make it more interesting. Yes, the short answer is DLT can definitely help in settlement acceleration and settlement discipline. So one of the other areas that I think is quite interesting is the CSDR regulation, or CSDR. The R is for regulation, so sorry for that. But CSDR is also asking for settlement discipline, and I think DLT there can help reducing a lot of risk and removing a lot of the inefficiency and the failed settlements that will be quite punitive for the industry to continue to have. But in terms of settlement acceleration, DLT is the right technology for it, and we are seeing live projects with DTCC, Project Ion, that they are using DLT, and we are lucky enough to have been chosen, or our technology is robust enough for them to have chosen us, and we are quite involved in that project to make sure that settlement can be accelerated to T+1, and that will have many benefits to the participants. Ultimately, it will allow people to deploy capital faster to the real economy. So that is the ultimate goal. But you can only do that if the technology allows you to do so. The move from T+1 to T0 is a different one. So whilst the technology also allows for that, the T0 raises a few other governance questions and roles questions that I think the industry needs to first understand T+1 fully, get the benefits, quantify the benefits of moving from T+3 to T+1, and then when the time is right, moving to T0 eventually. But the technology definitely allows for both.
Mm-hmm. Well, something that would definitely help move to T+0 is getting the cash leg of securities transactions onto the ledger, if you like. Now, central banks, in this case, are the regulators that are relevant. And if they created central bank digital currencies, put fiat currency, made it available on the ledger, that would enable faster settlement to be achieved. Now, that's some way off, I think, in major markets. So what about working with stable coins? Let's say that an infrastructure decides to use stable coins for the cash leg when it first gets going, with a view to adopting CBDCs as and when they become available. Does that make it easier to adopt CBDCs when they come along, or does it actually make it harder? Maybe you have some general observations here on the balance between stable coins and CBDCs in the future.
Yes, I have personal views, Dominic, as most of the views on this interview. We normally like to think of it as tokenized cash. And the reason for that is there are some stablecoins projects out there, some of them more successful than others. You probably saw that a couple of weeks ago, Facebook or Meta decided to drop their DM project, which basically tells us that the stablecoin is an interesting space, but probably not one that we are currently completely focusing on. We are more focused on tokenized cash and ensuring that the ledger solutions that we bring have as you described, the cash leg in a token format, so you can move both the assets and the cash at the same speed with and providing DVP, delivery versus payment, DVD, delivery versus delivery, if it's two assets, or PVP, payment versus payment. So our view is that cash is key in a token format to ensure that both sides, the asset and the cash, move at the same speed. Stable coins are definitely something that some of our clients ask us to look into. I think together with that, we look into the tokenization of cash to ensure that the network has that element. But going back to your question and the linkage with CBDCs, we believe that yes, the ultimate goal is to bring the CBDC into the ledger. So, and by tokenizing the cash now, we can, once the central banks are ready to adopt or to go live with CBDCs, the idea is that we can just plug in that CBDC into the network. Did that answer your question?
Well, you said it makes it sound easier, but I'm interested by the distinction you draw between stable coins and tokenized cash. I think many people would see those two as kind of merging into a single type of substance.
Yeah, that's fine. Fair point. So a stable coin, the way I see it is you have a token that represents one-to-one or has a relationship with the underlying reserve, which, for in the example of a circle or a tether, it should have a reserve that ensures the value of that coin. The way I'm describing tokenized cash is in a network, the network participants have deposits in their network. Imagine a regulated liability network that each of the participants has deposits into it, or cash that they have in that network, and they can tokenize it and bring it to that network. So it's not a currency to be used by all the participants out there, but it's something that the participants of that assets network agree between themselves to have a form of cash in a token format to ensure that the asset can remain liquid. So that's the distinction I'm drawing. A stablecoin is something that has a wider reach than a tokenized cash into a regulated network.
Yeah.
Did that make sense?
Yeah, that's a very helpful distinction, because it prompts a second thought in my mind, which is this. One of the factors that the securities industry has dealt with, security services industry has dealt with for a long time, is the internalization of settlements. So if two clients of the same bank are doing business with each other, they can settle it within the bank without going out into the financial market infrastructure. And we see that stablecoins are being used by banks such as JP Morgan and Wells Fargo in a very similar way, not yet as far as I know in securities, but certainly in their trade and normal payments businesses, they're starting to settle transactions using a kind of internal stable coin. Is part of your planning the idea that stablecoins might evolve into a similar sort of role in the securities or money markets or funds industries?
Yes. So let me go back to those examples, because those are great examples of tokens or tokenized cash that both JP Morgan and Wells Fargo use. There's a reason why they're not exposing that to other participants. So whilst it's great for them to use it and make their internal operations faster, safer, and with less risk, because of some of the unclarity that or lack of clarity that exists around the prudential treatment of stablecoins, exposing those stablecoins to other participants might create some very punitive RWA treatment, and that's probably the reason why some of those currencies that or tokenized cash forms that banks have created are not being exposed to other participants. So that is on the stablecoin question. Then the rest of your question, Dominic, sorry, help me here.
I think it was about internalization. Whether
yes, so
but
definitely, yeah, it definitely has it allows for banks or even other large corporates that have operations in multiple places. The fact that they can do those transfers internally without having to go external and using the traditional ways that can be costly, that take 2 days and so on. Yes, there's a lot of advantages of doing so, and we can expect more of more adoption of such solutions in internalized networks. The other thing that we are also seeing is projects such as Finality and others, where they're trying to bring more participants to have this settlement coin between themselves that will eventually make the payments and the settlement faster and safer. So we have both. I wouldn't think that privately issued coins would be used very widely, particularly the ones issued by banks, would be used very widely because of the capital treatment. But once those things are addressed and understood, and some of the BCBS consultation was about that, the treatment of the different assets, stable coins, crypto assets, and so on, was all the same way. And I think the industry gave a lot of feedback on the BCBS consultation to ensure that netting and stable coins were treated differently than other crypto.
Yeah, and I guess that distinction between commercial bank money and central bank money will persist into the future as well, and not necessarily just in the form of CBDCs either. But I guess what Finality is trying to do makes that point as well. Anyway, to move on to, or go back to what we were talking about CSDs, one of the clients that you're working with at R3 is the Archax subsidiary Montis, which is building a digital CSD. Now, the answer to this question might be very straightforward, might be, well, the European regulation says you have to use a CSD, so Archax has to have one. But I suspect the answer is more interesting. Why does a DLT-based digital exchange like Archax actually need a CSD when the whole point of DLT in general, and I have in mind here particularly the benchmark EIB bond issue in April last year, which we all paid very close attention to, that wasn't issued into a CSD because you don't need one really, do you? So what's the logic here of Archax and Montis building a digital CSD?
So I think there are roles, and again, let's go back. Some jurisdictions still need a CSD for finality, and the vision is that CSDs and other FMIs will still have their role of ensuring fair and efficient markets and so on. So the idea is that the technology works in each case, but if you need to go into the CSD flow and make sure that the bond is there on the CSD, you can also have that node. But the idea here is that the digital CSD, as we are talking about, will ensure the governance, will ensure the standards, will ensure all the good practices that the CSD needs to have. Then for settlement purposes, whether it goes to the CSD or not, that will be aligning to the regulation that is required in different states. So that's the idea. Did that answer your question, Dominic?
I wonder if there's a long-term agenda here in which, in a way, CSDs become a continuing important part of the ecosystem, because they've certainly changed their role. They've changed the things that they do, and so they don't do necessarily the sort of issuance and settlement and safekeeping functions they do today. They do all sorts of different things, and I wonder if, in fact, if Montis is a forward-looking project.
Yes. So
as well as trying
yes,
to
it is.
comply. Yeah.
But the idea is, in any of these projects, particularly in this regulated space, you need to understand um, how it works and make the bridge of the technology today and what's required today, and then see what redundant steps are there to make it more efficient, but always ensuring it's the right process for the problem that we are trying to address. So that's the idea, is that the technology can, and it goes back to the settlement point. Whilst technology is able to deal with the settlement in T0, it's not the right time to go for it. So, and the same thing here, the CSD step for settlement can probably be removed at some point, but it's not our role to say whether it's needed or not. There's regulation in different jurisdictions to say so. What we want to show is that the technology enables for the different models that are likely to occur. Some states might require a CSD, some other states might not require a CSD. The idea is that the technology allows for being compliant with both, whilst ensuring more efficiency and removing some cost and risk from the system.
Yeah. So it's about building bridges to the future, as well as
Yes.
getting to the future immediately. Talking of which, we often talk as if getting rid of intermediaries is what DLT is all about, and CSDs are just another intermediary we can jettison in due course. But are there asset classes or financial markets which don't have the sort of CSD style post-trade financial market infrastructures today that you think might benefit from having one? And what I have in mind here is another of your clients, Instimatch, in the money markets, where it's actually introducing a financial market infrastructure to a market that doesn't have one before.
Thanks, Dominic. You continue to bring great examples. So thanks for that. So that's our vision as well. That the roles will adapt and evolve, and principles and procedures that were adopted in other asset classes can be now used in new asset classes, or even traditional asset classes such as money markets might now adopt some standards that previously they didn't. But the idea here is that the FMI, independently of its role, it will always be, no one can disintermediate the trust. So the trust of these central FMIs that are managed according to the PFMI, the Principles for Financial Market Infrastructures, from BCBS IOSCO, I believe. So that role, from a regulated perspective, will continue. How that role then is done can be done differently depending on the technology that you're built in. The idea here is that now you can start bringing other assets using the same sort of governance and trust and principles that we try to bring to this space. So that's effectively how we see it, is that the role of the FMI can potentially be extended to new asset classes. You mentioned money markets, but some people come to us talking about crypto ETFs and so on. So it could be, you can apply the same principles and trust and governance good principles into either other assets that existed that previously were not governed by the same principles, or new assets that come in. Because the reality is that investors need safety in order to put their cash there. And the idea is that the technology can enable it, but it's not our role to define it. There's other people, the regulators and the participants, that are in a better position to know what those features are. What we can ensure is that our technology allows for them to build those features into the smart contracts that then will be issued into the networks.
Now, we've talked about building these bridges to the future. You can't achieve these things immediately. You have to do it over time. Timing is important. You also said a minute ago that no one can disintermediate the trust which these financial markets infrastructures provide. You referred to the Principles for Financial Market Infrastructures, published by the CPMI, IOSCO, the committees of the BIS. Anybody visiting your website would read that R3 believes that, what you've just said, that you can never disintermediate the trust in these established financial markets. You're always going to need these trusted, regulated intermediaries. And so my question is this: if the intermediaries persist, and the blockchain story has always been that you get rid of the intermediaries, that's how you make them more efficient. How can you make markets more efficient without disintermediating people? How do you cut the costs without losing people taking bites out of the value chain as it passes by?
That's a very good question, Dominic. So, and it's one that usually some of our clients ask us, and I think the response is twofold. One, there is definitely middleware that the industry is using that might not be needed in the future, and that middleware themselves might need to. And some of them are engaging with us in projects to bring their processes into a DLT environment, because the reality is that the trades, the interactions can all be on the network, and then you just bring the value add processes on top and products. So whilst people can keep those processes that have value add, I think a lot of the reconciliation, a lot of the middleware that the industry ends up using, which is quite costly, can definitely be removed. And what that will mean to some of the businesses that live from that from the middleware that they provide, they will need to adapt into this new technology, or they might end up with a different role. But the idea here is that it's not for R3 or us to determine whose service has more value than others. What we are trying to provide is, if you have a network, build it in Corda and offer your service to a network of clients, and those clients will have trades, and you can then bring the value-add services into it, whilst removing heavy reconciliation processes, heavy files going back and forth between different participants, heavy trade reporting machinery. So all of those things can eventually be removed, and that's our vision. But it's not for us to determine that reconciliation engine is less valuable than others. But that will be something that the market participants will naturally adopt or not, if they still see value.
I can see that you can preserve the intermediaries. They end up doing a lot less reconciliation amongst themselves, and over time they start to ask, well, how much value is this particular form of intermediation adding? Maybe we need to do something different. So it kind of evolves over time. I can see that very clearly. But there must be markets in which, if you do introduce DLT, a kind of almost immediate consequence of what happens is disintermediation. I'm thinking here of the mutual fund market. I know you're working with Fund Admin Chain, who's looking to introduce a tokenized model into the mutual fund markets. And it seems to me, and I've looked at this quite closely, if you introduce a DLT model into that market, it's very difficult to see why you would need to persist with the order routing networks. I mean, the Callistones and the Bestamers and the fund settles here in Europe, and of course FundServe in the United States. Why would you need those order routing networks? And also, why would you need the transfer agents actually to do the settlement? They might find something else to do, but that settlement function they have, dealing with the banks and so on, would almost inevitably disappear. Otherwise, why would you bother to introduce DLT to the funds markets? Is my example unfair? Are there other markets where you get that immediate change?
So I agree with you that some of the business models will need to adjust. The way we view it is that, interestingly enough, it's usually those that are central to operations that end up being the ones more proactive in trying to adopt better technologies. For one simple reason, Dominic, they know how critical their processes are. And usually those agents end up in the difficult space of having risky processes that they end up managing, and the technology that they have require lots of different sources of data and so on. If they bring those processes into a technology that removes their risk from the system, it's beneficial to them, and therefore they are in some cases the ones that are on the forefront of seeing whether this technology can be adapted to their business and their case. And in some cases, that's how it works. And they can also, whilst reducing risk, in a lot of cases, they can reduce risk, cost, and therefore their operation can become more profitable, and they offer a better service to clients. But look, there will be examples where some providers might fail, and in this transition they might not be able to do it. But again, that is not the purpose of the technology. The technology is there to make the processes more efficient to anyone that currently interacts with regulated financial institutions. So our vision is that everybody that has currently operations with these participants can potentially benefit from a network and the distributed ledger technology to orchestrate some of the interactions between all of these participants. Mm-hmm. It's not for us to say this process will have less value than that other process. So, but going back to your question, some might survive, some might not, but it's not a disruption that we are actively looking for. It's like business, like any business. Blockbuster probably saw Netflix and didn't react, and they disappeared. But it's not for us to say who's Netflix or who's Blockbuster.
Yeah, and I guess listening to you, one of the factors at work here, which we're likely to underestimate, is that the service providers themselves are not in complete control of that speed of change. They might, as you say, the technology has no intent. They might adopt the technology and find it makes them more efficient, but maybe their clients are not really comfortable with that yet. They want somebody to stand between them and the various risks and make them whole if something goes wrong. So you can only move at the pace of your users. You don't control it entirely within your own organization, do you?
That's right. And that is where some challenges might come to some firms, because the time for adoption can be quite resource consuming, particularly for new firms that come to the market. Some of these projects take several years, and that can be a factor. And I think that's why regulators are so actively they see the benefits. They see that there are risks, systemic risks, that can be better addressed with this technology, and therefore they're creating the space to prompt adoption, removing some of the uncertainty of participants, is this safe or not. So but we can't control the speed. What we are seeing is that because some projects went live, there is more appetite, and with the right enabler context with regulation sandboxes and others, we see a lot more interest in being active in this space. And hopefully the network starts growing by bringing more of these projects to life.
Mm-hmm. Well, one reason it's going to be resource intensive for them is that they'll end up for a period of dual running. They'll have some clients on the old system and some on the new system, and they've got to support both of them. But that creates another problem, doesn't it? That you've got DLT networks operating, and you've got the traditional infrastructures operating as well. And these two are somehow going to have to be linked. They're going to have to interoperate with each other.
That's right. And yeah, sorry to interrupt you there, Dominic. Finish your question.
Well, I was only going to ask whether that's a particular problem with CSDs, or it's a problem across all financial market infrastructures.
It's a problem across all financial market infrastructures. You can't forget the old or the legacy or the traditional and just build on the new. But there's different models. You can see an SDX that's created a new completely digital exchange where they still have the Swiss group exchanges in the traditional model, but their vision is that at some point that the digital side will overtake the traditional, but you can't switch off the traditional straight away. But the idea is that you can the new process using DLT can actually cope with the traditional finance side, and you naturally can bring more business into the digital ledger technology orchestrated processes. So, but there's different approaches. There's the Swiss group that created the separate entity. There's, for example, Deutsche Börse on D7. They are building the digital within themselves, and some others are doing similar projects. But the idea is that, yes, you can't switch off the legacy straight away. But what you can do is choosing the processes that you want to migrate so that you bring efficiency and you can achieve break-evens as you migrate to the new world. And by removing the cost of the legacy, the replacement cost on the new technology should be at least the same or less for you to have the incentive to make the change. And what we are seeing is that a lot of the clients, when they go through these numbers, they see that yes, there's cost savings to be made, in addition to the risk reduction that they can achieve.
So cost saving plus risk reduction is a larger number than dual running.
And legacy.
Exactly.
Yeah.
Okay.
Exactly.
Now, but just on the narrow question of interoperability, what is the key to that? Do we need standards, in a word? And are we getting?
Oh, yes. Yes. So interoperability is a great question, and we have we have active projects ensuring interoperability between old and new, or if we want to use other traditional and decentralized finance. So we have interoperability between public and permission blockchains, and then interoperability between networks within our Corda environment as well. So interoperability, again, the same concept that I was trying to earlier allude to is we don't want to pick winners. It's not our job to pick winners. Our job is to integrate and interoperate with whatever makes the end client's life easier and better. So the idea is that the future will be multiple chains that will need to interoperate with each other, and our vision is exactly that. We need to interoperate with public chains. We need to interoperate between old and new systems, and we need to interoperate between new and new systems. So that's definitely the vision. And for that, going back to your first point there, standards are critical. So I think that understanding of what standards the industry should use definitely prompts interoperability. And again, not only regulation has been an enabler, but we also saw the common domain model projects that actually try to ensure standards harmonization across different asset classes and assets, and that is very helpful to anyone working with these technologies, because you can interoperate with whatever solution that ends up there.
Yeah. And we referred repeatedly to systems, platforms, or whatever, but it's not, of course, just new systems, new platforms, actually new asset classes as well, like crypto, like DeFi, now like NFTs. To what extent is the work that R3 or what Corda is doing, or maybe a more basic question is, how can Corda help? I'm a CSD. I've got users who want to access cryptocurrency, DeFi, NFTs. How can you help me do that?
So that's a question that we get more and more, particularly as those markets are quite getting a lot of attention, not only because of the volumes that they move, but also some of the significant returns that they offer. So we get a lot of questions in that space, and our approach is the idea for us is that we need to ensure that people can participate in those networks, and sometimes they don't need you don't need to go to the native cryptocurrency. If we see bond issuances in public blockchains such as Ethereum, the idea is that at the end of the day, the holders of that asset, either crypto or a public issuance of a bond, those assets might end up in a permission blockchain such as ours. It's likely that regulated financial institutions will want a permission blockchain to keep those assets secure and ensuring the security of the and the privacy of the holders. So the Corda is definitely building bridges across the different asset classes and the different products that are out there, and we also have not only interaction with some or projects to interact with some of the exchanges, but we also have the concept of a decentralized exchange, which we show on our central bank digital currencies sandbox and demos. We have the concept of a decentralized exchange there, which is effectively point-to-point people being able to transact between themselves.
Mm-hmm. One final question for you, Goncalo, and it's this. It's a slightly unfair question, because I'm going to ask you to peer deep into the future. We've talked...
You leave the best to the end.
Yeah, well, the most difficult to the end anyway. We've talked a lot about CSDs, but there are lots of other infrastructures out there, financial market infrastructures. In the securities markets, you've got central counterparty clearinghouses, you've got trade repositories taking reports on derivatives. And then, of course, you've got, and these are linked to the securities markets, the payment market infrastructures for the cash leg. I'm talking RTGSs, I'm talking automated clearinghouses, I'm talking of CLS in the FX market, I'm talking of SWIFT in cross-border payments. As you look forward, do you think, and you've been very clear about this, that you're not picking winners, you're here to supply technology, you think to make things more efficient, and it's up to the market participants to evolve those technologies in ways which make most sense for them and their clients. But as you look far ahead, do you think we're going to need all of these infrastructures, or are all of these infrastructures going to have to change themselves, adapt to change? What's your high level view of how it's going to look as you peer 5, 10, 20 years ahead?
So I think we will move to the DFMI or DMI, the decentralized infrastructure, market infrastructure. And I think that's the vision that a lot of our participants look into. And if we go back to the list of FMIs, so trade repositories, CCPs, CSDs, payment systems such as securities or then cash. So all of those using DLT technology can make their processes more efficient and less risky. So, for example, settlement can be made instantaneous and atomically, swapping the assets, which remove a significant portion of credit risk from the system, which is a good thing. So the view there is that yes, those FMIs will still be there, but can use the benefits of this technology to make sure that that the world becomes a less risky place and the capital gets deployed faster into the economy, which is, so that in terms of settlement, I think the view is we will still have settlement systems that are governed and follow the principles of by CPMI. They will still exist in probably more efficient forms. You mentioned CLS. CLS is, of course, widely used and owned by several banks. The idea is that the CLS concept will remain useful in the future. Does CLS need to be solely used in 16 currencies? Probably not. Probably it can be extended with this technology. You're almost currency agnostic. You just use the same process, PVP, and you remove the credit risk from the system. But again, CLS can adopt this technology and make their process faster and better. Same thing with SWIFT. The SSIs on a SWIFT instruction will move from SSIs to become wallet IDs. But again, the format and the standard that SWIFT implemented is probably something that the industry will still use in whatever network they are operating. And finally, the trade repositories. Currently, there's masses and masses of files and megabytes or gigabytes of data that everybody is sending to APAs, to regulators, and so on. And trade repositories themselves can make their process better if they have access, or if access is granted to the trade repositories for the fields that they need to see, of the trades that they need to see, in the format that they need to see it. It makes the whole industry much more efficient, and with savings, for example, in terms of energy consumption as well. So if we all have a better orchestrated market, we can all use less resources to make it work. So going back to your question, I think all of those FMIs will need to adapt and evolve. The technology that we offer can help them on that journey, but there will still be processes that will need to be done outside DLT. So DLT is very efficient in removing these silos, in making things more efficient, but at the same time, there are processes such as matching trades, matching engines that are probably better done outside of DLT because of the speed and because of other processes that are already very well invested by the industry to make it work. So the view is that there are processes that are legacy that can be moved into the chain. There are processes that, if they're better done off ledger and off chain, they will stay that way. But the idea is that you can interoperate between the most efficient processes when needed.
So that was my last question. I'm going to be very greedy, because you made me think one more thing when you refer to CLS and to central counterparty clearinghouses. The benefit one of the big benefits both of those entities deliver, both CLS and CCPs, is netting. You're saying that we can preserve the benefits of netting while using DLT technology. Is that right?
Yes, that's right. So I forgot to mention the CCPs, so thanks for bringing that. So CCPs definitely have an interesting role, and with this technology, they can make better use of the collateral and the capital that institutions end up using. And yes, netting can be done real time even. Instead of just doing a cycle at a specific time, or using this multilateral run. So a lot of other netting solutions and novation solutions can be used, both by these traditional financial providers, but also from others. A lot of commercial firms have netting solutions and compression solutions. They can be adapted or built into the network, and instead people sending spreadsheets with trades, they can actually both look at the same version of the trade and say, I want to compress this trade, dear counterparty, do you agree? And that makes the whole process safer, sound, and so on. And CCPs also. The only issue that I think CCPs will need to look into is when settlement eventually moves to T0, the CCP role will be quite an interesting one, and governance around it might need to change, because if you're settling in real time, the role of a CCP needs to be adapted, and the governance and some of the way they operate needs to be adapted. But again, it's a space that I don't have the answers to. I think the industry needs to sit down and see how, once we crack the T+1, how would we move from a T+1 to a T0 world?
And keep the benefits of netting. I think you're saying that netting
Yes.
and faster settlement, at least, if not instant settlement, are not contradictory. You can have both.
Yes, you can.
Okay, that's a very good note to end on. Goncalo Lima, thanks very much for taking the time to talk to us.
Really good. Hopefully it was helpful. It was a pleasure.